Welcome to the podcast on stabilizing the economy. In previous podcasts, you learned about how economic indicators can help economists and government officials know how the economy is doing. In this podcast, you will learn about the tools the government uses in order to stabilize the economy. The tools used today have come about because of past economic theorists. Therefore, I will start off with a discussion of two economic ideologies that have influenced economic thinking over time. I will then talk about monetary and fiscal policy. To start, there are multiple economic schools of thought when it comes to stabilizing the economy. Stabilizing the economy is important in order to smooth out the business cycle and protect people from economic peaks that are too high and troughs, which means dips, that are too low. We don't want the economy to enter recessions, but we don't want it to grow too fast either. Both can have negative impacts, as discussed in the Economic Indicators podcast. In this podcast, I'm only going to talk about two schools of thought, only one of which actually advocates for much government action to help the economy. These two schools of thought are called classical economics and Keynesian economics. First up is classical economics. It's the most straightforward of the two. The bottom line in classical economics is, don't do anything. Let the economy fix itself. This laissez-faire approach maintains the viewpoint that the business cycle should happen regardless of the effects it has on the people. This is because the market is able to correct itself over time. This theory emphasizes the fact that there are reasons behind why the economy experiences ups and downs, and that a handoff approach leads to economic efficiency over time. Let's look at an example to help explain this last idea. At first, farmers are making profits growing their corn. Because of that, more farmers enter the market and start growing and selling corn. However, it also takes resources like water and land that costs money. As we know from the concepts of supply and demand, when there are more sellers than buyers in a market, the equilibrium price goes down. That means corn is now cheaper because there is more competition among sellers to sell it. This means not all farmers can make a profit. At this point, after year 2, there are a lot of farmers who can't sustain their farm business. While this sucks for those farmers, classical economists argue at this point it would be irresponsible to help out the farmers. This makes a lot of sense. There are too many corn farmers in the market. Clearly, the country doesn't need so many of them. If the government were to get involved, there might still be too many corn farmers. Therefore, the best course of action would be to let the farmers who can't survive leave the farming industry altogether. The benefits can then be twofold. First of all, the farmers who lose their farms are going to find work elsewhere in an industry that actually needs workers. And second of all, with those farmers out of the industry, supply will decrease and prices will rise again. This will not only enable them, the farmers, to make more that are still in existence, to make more money, but possibly expand their businesses as well. This is efficient because in the long run, those failed farmers are working in other areas that needed workers, and the remaining farmers are better off. Everyone is making money again, and the government didn't need to spend a dime. Sounds great. But there are some problems with these assumptions. This is what will happen in theory, but the problem is that life is a little more complicated. Classical economics doesn't take into consideration things like natural disasters, pandemics, hunger, lack of alternative jobs in cities, people not being able to move locations easily, etc. So while classical economics presents a strong argument for lack of intervention, modern classical economists recognize the need for at least a little government involvement. Now, let's look at the other end of the spectrum. This second economic ideology is known as Keynesian economics. John Maynard Keynes's economic theories are especially influential in shaping how countries like the United States actually respond to periods of economic decline. Keynesian theory advocates for governments to get actively involved in the economy in order to prevent and lessen economic highs and lows, especially lows, in the business cycle. Keynesian economics is often said to advocate priming the pump. This means that when the economy is weak, more money needs to be available or pumped in to the economy. And when the economy is strong, to put less money into it. This is done through both monetary and fiscal policy. Before we get into these policies on their own, though, let's look at a general example of how Keynesian economics works. This example starts out the same in year 1 as classical economics. Thus, in year 2, more farmers enter the market. Here's where it changes, though. The government sees that prices are too low for farmers to survive financially. Therefore, the government spends money in order to reduce supply in the market. This enables the farmers to survive and turn a profit. Because of this, the farmers are in a better financial situation heading into the 3rd year. They can survive the drought long enough for corn prices to eventually increase, helping them to make a profit again. In fact, the farmers are doing so well that the government no longer needs to keep spending money to buy more corn. This lowers corn prices, helping consumers. While the farmers may not be making as much once the government stopped buying as much corn to ship overseas, they are still able to stay in business by year 4. Now, if prices get too low again, the government can always begin to buy up more corn in order to help the farmers once more. Farmers are not constantly worried about losing their farms, and no one has had to become unemployed, go hungry, or move locations. That sounds great. However, there are problems with this theory as well. The government may have to keep on subsidizing, spending money on farmers to artificially stabilize prices, and that money has to come from somewhere, namely taxpayers. Also, if there are more jobs available than workers in cities, then workers aren't distributed efficiently because there are too many farmers and not enough, let's say, factory workers. Those factories might not be able to produce as much, making their products more expensive. These are just a couple of examples. However flawed, though, most advocate for a more Keynesian approach to handling the economy because the government does indeed have the ability to correct problems that occur and thus protect people from economic harm. So, let us explore the 2 ways that the government has at its disposal, monetary and fiscal policy. Before I delve into fiscal policy, I need to explain the difference between expansionary policy and contractionary policy. Whether fiscal or monetary, economists are trying to either speed up or slow down the economy. Expansionary policy is used during recessions or in times of low GDP growth. The goal is to increase the GDP and decrease unemployment. It does come with the possibility of causing inflation, though. Contractionary policy is focused on slowing down the economy. It's used when the economy is growing too fast and causing inflation. Despite having either expansionary or contractionary goals, fiscal policy and monetary policy are very different. Fiscal policy is the easiest of the 2 tools. This tool is purely Keynesian and was famously used to help the country during the Great Depression. Fiscal policy is made exclusively by Congress, though of course all laws must be signed by the President. Congress has 2 things basically that it can do regarding the economy: taxing and spending. Again, remember, fiscal policy is taxing and spending. In order to speed up the economy, Congress can lower taxes. This is because if people pay less money in taxes, people have more money to spend. They will then buy more. This means production of products will increase. Not only will this increase the GDP, but it will create more jobs for people. Thus, lowering taxes expands the economy and is expansionary. On the other hand, if taxes are raised, people will pay more in taxes and have less money to spend on other things. This means they will want to buy less, slowing the GDP and causing higher unemployment. But, and it's a big but, it will decrease inflation, keeping prices down and making products more affordable for the people. Thus, raising taxes contracts or slows down the economy, which is contractionary fiscal policy. Now, spending is the opposite because in order to expand the economy, the government can increase spending. For example, if the government spends money by increasing unemployment and Social Security benefits, people will have more money to spend. The same can be said for giving money to businesses in poor economic times so that they don't have to lay off as many employees. On the flip side, decreasing spending will contract the economy. For example, if the government cuts defense spending for a military base, then the Defense Department may have to cut jobs, and companies that were going to produce products needed for the base might stop production. This will slow the economy down, contracting it. That's fiscal policy in a nutshell. Remember that fiscal policy is government taxing and spending. Monetary policy, on the other hand, is a bit more complicated. It was not developed by either the Keynesian or classical economists, but it was advocated by Keynesian economists because it was still a good way to stabilize the economy. Classical economists might have believed in a hands-off approach, but over time, as mentioned previously, they embraced monetary policy as a way to deal with some of the market failures that do occur. In order to understand monetary policy, you first need to know that monetary policy is conducted by the Federal Reserve Bank. It's known as the Fed. The Fed is run more like a private business in that it makes its decisions independently of the three branches, but it's still part of the government. Also, the chairman or the head of the Fed is still appointed by the president. The Fed has a few roles. It is sometimes called the bank's bank as it helps them out when needed. It is tasked with making sure the financial system in the United States runs smoothly and establishes certain rules for banks. It also makes sure that banks aren't in danger of failing. The Fed has many other roles as well, but its most important role is conducting monetary policy. The Fed has three tools at its disposal. It can conduct open market operations, which is the buying and selling of treasury bonds. It can change the discount rate, which is the interest rate charged to banks if they need to borrow from the Fed. It can also change the reserve requirement. This changes the amount of cash money banks must keep in their vaults, which then changes the amount of money banks are able to lend out in the form of loans to people. Okay. While I very basically gave you an idea of what each of these three tools is, I'm not concerned with you knowing what these are in depth or the specifics of how they work. Rather, I just want you to generally know that these tools lead to a change in the money supply and interest rates. What are interest rates, you may ask? Well, the interest rate is the percentage a lender, usually a bank, charges on a loan. Banks need to make money, and they do so by loaning out money. However, if a bank lent out $10,000 and didn't charge any extra money to the borrower, then they wouldn't make any money. In fact, due to inflation decreasing purchasing power over time, they would end up losing money on the loan. As a result, the bank might charge a 5% interest rate, which would increase the borrower's total cost for the loan by 5% of $10,000, which is $500. A bank doesn't decide on the interest rate it charges for a loan by itself, though. Instead, the Fed uses these three tools at its disposal to manipulate the going interest rate. Open market operations is the main way in which the Fed manipulates interest rates, but all three of these monetary tools can be used. All three also affect both the money supply and interest rates. Open market operations and the reserve requirement directly affect the money supply, which in turn affects interest rates. Technically, the discount rate first causes a change in interest rates, which then leads to a change in the money supply, but the results, both expansionary or contractionary, are the same. This is because everything boils down to interest rates. Individuals and businesses spend more when they borrow, which in turn expands the economy. When interest rates are low, people pay less money in interest in addition to the amount they are borrowing. As a result, more people are motivated to borrow when interest rates are low. This results in expansionary policy. Contractionary policy yields the opposite result. When interest rates are high, people are required to pay more money in addition to what they are borrowing. Since that makes it more expensive to borrow, it results in fewer people borrowing. Just like expansionary fiscal policy, expansionary monetary policy leads to more spending, which leads to an increase in GDP, a decrease in unemployment, and an increase in inflation. Just like contractionary fiscal policy, contractionary monetary policy leads to less spending, which leads to a decrease in GDP, an increase in unemployment, and a decrease in inflation. So, to summarize, you've learned about classical and Keynesian economic ideologies. Classical ideology advocates for little to no government involvement in the economy, and Keynesian ideology advocates for the government to fix problems in the economy. You've also learned about the two types of policy, expansionary and contractionary, that will either speed up or slow down the economy. Lastly, you've learned about fiscal and monetary policy. Remember, fiscal is Congress taxing and spending, and monetary is Fed changing the money supply and interest rates. Well, now you've learned the general ways the government can use to stabilize the economy. I encourage you to see how Congress and the Fed have recently used these tools. Thanks for watching.